chart you see here to my right is the VIX, VIX. When Trump took office, this was down substantially. This is actually the VIX futures. This is not VIX. This is, I typed in VIX, but I got VXX. Pulled this from Robinhood. And so what it shows is when Trump took office, we were down here near lows for the month of January. Since then, we've popped up a bit. We've popped up a bit there just after, just after Trump took office. Got a little bit of a wiggle back to the downside, and now here's what's happened today as we've kind of popped up quite a bit. Where do we go from here? So it's going to be an interesting 12 hours, because if there's no deal from Canada, there's no deal from Mexico, then I think we move higher and we move back up, and I believe we could tack on about another 20%. May not all come in one day, but we could tack on a good 20% here for the short term. When the VIX goes up, that's not typically good for the markets. But aside from all that, we could talk about ifs and whens all day long, but I'm a pattern trader. So what I like to do is find expensive volatility now. Expensive volatility now, I took a look at, and I have a number of ways of looking at this. We can look at, and I use options. So I look at options, and I look at, what options have the highest volume, what options have the highest open interest, which options have unusual call option volume, what options have unusual put option volume, what options are the most cheapest coming into today versus where they've been in a range over the last year, and what options are the most expensive. Same thing. I want to look at the last one, the most expensive options. So when I look at the top 10 most expensive options, I see options that are, where is the low, where is the high, where are we right now? Okay, the highest, the lowest, and today. And so as you can see here, here is the highest implied volatility for the top 10 I see on the screen. Here is the lowest implied volatility for the top 10 on the screen. Here's where we are coming into this morning. So these top 8 that I have checkmarked, well, they all have one thing in common. Their high IV and where they clocked out on Friday are exactly the same. They are on the highs that they've been on for the year. All right. MHCP, Honeywell, BTU, all right, that's Peabody Energy, DEO, Learjet. Learjet's on a high, and Learjet's on a high because of what happened in Philadelphia, right, very recently with that Learjet crash. Garmin's also on a high. OLED, that's the LED TVs. HII is the top 8. Then you've got Palantir and you got NVDL that round out the top 10. Palantir and NVDL are high, but they're not on their highs right now. So take a look at these, and the first thing I noticed is that the bulk of them are earnings related, meaning that earnings are coming out in the next week or two. In fact, earnings, this is a big week for earnings. The S&P reports 20%. So that means roughly 100 companies in the S&P 500 are reporting this week. And a good bit of those are on that list. So what do we do as option traders when we look at expensive earnings? Do we buy expensive earnings? No. We want to sell these expensive earnings. So I want to be a net seller of time premium. And that means I could do a number of things that bring premium in. I could write covered calls against stocks that I own. Right? That's one thing I could do. I could do call spreads if you're an option spreader, right? That limits risk, but it also limits what you could bring in, and that is going to be a mild way of selling volatility if we were going to sell, write a call spread or write a put spread. But if you really want to be a volatility seller, you want to be a net seller of volatility, then what you're looking at is you're looking at selling pure premium. You sell calls or you sell puts. Now, I'm not a big fan of call selling because that really has unlimited risk potential, because stocks can go to infinity. But stocks can only go down to zero. So there is a floor to a downside. And so taking that into account, what I like to do is I like to, if I want to be on the buy side of an option, I don't want to buy a stock. I don't want to buy an expensive call. I want to sell an expensive put, because I do get the large risks and rewards by selling puts if I'm assigned, but I also get positive statistical probability with that because I'm bringing that premium in. If I bring that premium in, then I'm going to get something for that, for putting myself out there to assume an obligation, right? So a put option seller will obligate themselves to buy the stock. I want to make sure if I'm going to obligate myself, I want to put myself somewhere below where the stock is today. I'm going to get paid a premium for that. I get to keep that premium, right? I get to keep the premium if the stock goes up. I get to keep the premium if the stock goes down. I might get the stock for that premium, but cash secured puts are one of the best ways to create wealth. Now, upon looking at all of those expensive options, I have Garmin in there with some green. I got it shaded out in green. Why do I have it shaded out in green? Because of all these stocks, Garmin is the only one that's been trending higher. Everything else is like catching a falling knife. And I'm not a big fan of catching a falling knife. So I'm going to take a little further look at Garmin. So Garmin stock, if you look at the 6 months on here, all right, that, we go out there from, about August, the beginning of August, out there when it was trading around 165. And then the highs are up there in the twos, right? The low twos, 220. And we're just coming off about 215 as of Friday afternoon. I could see all kinds of interesting things. We've got some really good support down here around 205. We even have 38% retracement right around 200. And of course, I've got some other areas as well that I could take a look at. But there's some really good support in these areas, right? But I said to myself, let me find the options that have a 90% probability of expiring or something in that area. And folks, it's not the 205s and it's not the 200s. The 180s have that probability of expiring worthless. And this is with the stock price at 209 before market, right? You're actually going to end up getting a better, much better price than 120 because 120 was the Friday price, right? We've gotten a little bit of a drop on Garmin like most of the market, and that pumps the option price up even more. So back up a second. When are earnings? 19 days. So earnings are not until the 19th of February. So you could go in and look at the 21st of February. That's expiration day. But giving yourself an extra month does bring you into an area where you can actually get a much lower area for this. Give yourself a lot more premium to do so. So I wanted to bring one of these up, and I could have looked at something like a BTU or Learjet, all right. But when you take out the news that happened regarding Learjet, really indirect news, but still news. Take out the fact that OLED has been dropping because just the margins on electronics just gotten weaker, and then factor in what's going on now with the tariffs. These stocks have been dropping even before all this started happening. So, what I like to look for is those best-in-class type of companies that are, at the very least, giving me areas of support resistance and not breaking to new lows. So that's how I put all of this together and then finally go out there. So spot that opportunity. In this case, we're looking at a statistical probability, create that high probability trade. And in this case, we're looking at selling out of the money, giving ourselves a 9 in 10 chance of being at break even or better. And finally, planning, executing, and managing the trade.